All right, welcome everyone. Today we're going to get into a really important topic in financial accounting, one that's a lot more interesting than it might sound. We're going to be looking at pension liabilities. Now, this is one of those items on a company's balance sheet that can seem a little mysterious, but it's where accounting, finance, and even human resources all come together. And I'll tell you, understanding what this number really means is absolutely crucial if you want to get a true picture of a company's financial health. So let's get into it.
So I want you to start by thinking about this question. From a business perspective, what's one of the biggest, most complicated promises a company can possibly make to its employees? I mean, we're talking beyond a regular paycheck, right? Beyond even a yearly bonus. The answer is the promise of a pension. It's a promise of financial security that extends decades into the future, long after someone has stopped working there. And turning that very human promise into the cold, hard language of accounting, well, that's a huge challenge, and it's exactly what we're going to unpack today.
Okay, here's our official definition. Let's break this down piece by piece, because every word here really matters. First up, obligation. This isn't just a nice idea, it's a binding duty. The company has to fulfill it. Second, companies must account for the cost. Now this brings us to a huge concept you need to remember, the matching principle. A really common mistake students make is thinking you only record an expense when the cash actually leaves the bank. But that's not right. The matching principle tells us we have to record expenses in the same period as the revenues they helped create. So the work an employee does today is generating value for the company today. That pension they're earning is part of their compensation for that work today. So we have to recognize a piece of that future cost right now, not 30 years from now. It gives us a much more honest picture of the company's financial situation. And finally, the two most important words for us, used to estimate. This is where the whole thing gets tricky. It's where the science of accounting has to meet the art of prediction.
Before we get completely lost in the numbers and the calculations, let's just ground ourselves in this simple idea. This whole accounting entry, which for a big company can be worth billions and billions of dollars, it all starts with a simple promise. A pension plan, it's a strategic tool. Companies use it to attract and keep the best people, to build a loyal workforce. So, as a future business leader, you have to understand the why behind the promise before you can ever really understand the accounting for it.
And it is so important to get this straight. A pension is not a gift. It's not a gold watch at the end of your career. It's deferred compensation. What that means is an employee is basically giving up some cash salary today in exchange for a guaranteed income stream when they're retired. From the company's point of view, it's just another part of the total cost of having that employee on the payroll. The work someone does in their 30s creates a very real obligation that the company has to settle when that same person is in their 80s. That huge time gap is what makes this so incredibly complex.
So how do we make this promise official on the balance sheet? Well, we call it a liability. Now, for something to be a liability, it needs three things. It's a current obligation, it came from a past event, in this case, all the years the employee worked, and settling it means the company will have to give up something of value, usually cash. Now, here's another common analytical mistake, treating all liabilities the same. A pension liability is a completely different beast than, say, an invoice you have to pay for office supplies. With that invoice, you know exactly how much you owe and when it's due. With a pension, you don't know the exact amount and you don't know the exact timing. And that uncertainty, that's a major source of financial risk for the company.
And that right there, that is the multi-billion-dollar question. This is what keeps chief financial officers awake at night. Just put yourself in their shoes. Imagine you just hired a 25-year-old engineer. You've promised her a pension that's based on her final salary when she eventually retires. How on earth do you figure out the cost of that promise today? You've got to ask, what's her salary going to be in 40 years? When is she going to retire? And how long is she going to live after that? These are incredibly tough questions, but accounting rules say you have to come up with a number for them right now.
So the answer, of course, isn't a perfect, certain number. You can't have one. It's impossible. The answer is a very disciplined, very careful process of estimation. And for many of you, this is a really key insight. You look at financial statements, and they seem so exact, right? Down to the last penny. But behind so many of those numbers is a whole world of complex, carefully thought out estimates. Your job as a future analyst or manager isn't just to read the number, it's to understand the estimates that went into it. Now, this estimation process, it's not just a wild guess, not at all. It's a very formal, very disciplined field run by professionals called actuaries. Think of actuaries as, well, they're like financial fortune tellers, but they use a ton of math and statistics. They are masters of forecasting risk. They use economic data, demographic trends, all sorts of things to build these really sophisticated models to predict the future. And those predictions they make, we call them actuarial assumptions.
They're the building blocks for calculating the value of that pension promise. So what's so great about this slide is it takes that abstract idea and turns it into 4 very real questions. Let's spend a minute here. First, how long will people work? Actuaries look at historical data on employee turnover and retirement ages. Second, what will their final salaries be? They have to project inflation, but also how likely someone is to get promoted over their career. Third, and this is a huge one, how long will they live? Actuaries use what are called mortality tables, but people are living longer and longer, so these tables are always changing. Every extra year a retiree lives is another year of payments the company has to make. And finally, number 4, which is maybe the most important financial assumption of all, the investment returns. This is also called the discount rate. Think of it this way. To figure out how much money you need today to pay someone, say, 50 grand in 30 years, you have to discount it back to the present. The rate you use is what you expect to earn on your investments. If you assume a higher return, you need less cash today. A tiny change here, like 1/4%, can swing a company's total pension liability by millions, even billions of dollars. It's incredibly sensitive.
This chart just lays out the difference perfectly, doesn't it? An invoice is a certainty. You know the what and the when. A pension liability is a huge strategic uncertainty. The amount is a projection, and the timing depends on people's lives and the stock market. And this is exactly why being able to analyze a company's pension plan is such a high-level skill. It means you have to look past the number on the page and really question the assumptions that created it. Okay, so we've established that these pension liabilities are complicated, and they're built on a whole lot of uncertainty. But that leads us to the most important question you can ask as a decision maker. So what? Why does this one estimated number carry so much weight? Well, the answer is that this number has massive, real-world consequences for a company's strategy, its stock price, and sometimes its very survival. Let's connect this to the real world. For a lot of older companies, think about manufacturing, automakers. Their pension liability can be one of the biggest numbers on their entire balance sheet. Sometimes it's worth more than the whole company. And like we said, the fact that it's so volatile matters. Imagine you're an analyst and you see that a company lowered its discount rate assumption by just a tiny bit. Suddenly, the liability on the balance sheet explodes, reported profits drop, and the company looks way less healthy. This changes everything. Credit rating agencies look at this stuff very closely. A big, underfunded pension plan can scare off investors, make it more expensive to borrow money, and can even kill a potential merger. It's a number that really, truly can shape a company's future. I think this quote just perfectly captures what we've been talking about. The math part, that's all the strict accounting rules and the present value calculations. But the crystal ball, that's the unavoidable fact that we're trying to predict things that are decades away. And pension accounting has to live right in that messy space in between, trying to put a hard number on a very uncertain, very long-term promise.
So I want to leave you with this final thought to chew on. We've just spent all this time taking apart one single line on the balance sheet, and we've discovered it's built on this incredibly complex web of estimates. And guess what? It's not the only one. Really getting that understanding that is what will separate you from someone who can just read a financial statement to someone who can truly analyze it. Your job as you go out into the business world is to look at the numbers, for sure, but to always ask, what are the promises, what are the assumptions, and what are the judgments that are hiding just beneath the surface? Answering those questions, that's the real art of accounting for decision-making.